please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's concentrate on the rupee because it's now almost reaching out to 73, and with it you also have the bond yields rising up to 8.21. Let's invite Irene Cheung, the forex strategist at ANZ Research, and also Mitul Kotecha, the senior EM strategist at TD Securities. Both of you, good morning and thank you very much for joining us. Irene, for starters, the rupee has fallen enough perhaps to factor in its 4-year stable stint and the bad trade deficit. Are you expecting further falls in the currency?
Well, I think, yes, unfortunately, we are looking at further downside of the rupee. And, of course, for this week, market is basically, I think, paying attention to the trade numbers, which is going to come out in the next couple of days. And basically the theme about currencies, which run a trade deficit, current account deficit, continue to be targeted by the market. So I think that until we see on the external front, the dollar start to weaken or data start to improve in India, there could be little relief for the currency in the near term.
So Irene, I'm just trying to understand. I mean, from 68 to 73, it's been extremely swift for the rupee. The new development in this patch is the price of oil, the way that's moved. I mean, what sort of a deficit in the current account are you factoring in? Because the market anyway knew that we're heading towards 3% of GDP.
Yeah, that's right. But if you look at the past, the releases of the trade numbers, for example, in the past couple of months, it has been the deficit has been quite a bit bigger than what the market expected. So the market is just trying to be preemptive in a way, that it could actually surprise on the upside again. There's a fear of the market. And of course, when oil prices continue to head higher and we have news about inventory being low, geopolitics potentially hitting the supply of oil, etc., that is going to be negative sentiment, being continue hitting the currency.
The market's sliding now. Bank Nifty is down 125 points and the mid-cap index is down about 150 points. We really have to focus back on the market because a lot of stocks which are now seeing big slides. NBFCs, of course, leading it, Manappuram Finance, metals joining in, Jindal Steel and Power. There's Titan, which is down about 2.5%. PSU banks, Bank of Baroda, Canara Bank down. REC is down. Granules, even some of these pharma names now beginning to cave in. So let's see, the Nifty is still somehow in the green, but or just about only 4 points down, but not looking good on the markets.
Well, actually, Mitul Kotecha is also with us. Mitul, at some point, a rupee at 73 and bond yields at 8.21, do you see that bringing some stability and some buyers in?
Yeah, I mean, I think it's a good point. There's some value that's starting to be seen in Indian bonds and actually in the currency. But the problem is that the external environment continues to remain negative. And I think, as we've just heard, India's trade deficit continues to worsen. The current account picture has deteriorated. And the reality is that unless oil prices decline significantly or the RBI engineers some significant measures aside from FX intervention. We've heard talk about trying to tap NRI deposits and perhaps other measures in terms of restricting imports, and perhaps that would help. But the reality is that investors are still very fickle. I think there's a lot of reluctance to invest, not just in India, but in emerging markets. And given the externalities of higher US rates, strong dollar, events in the likes of Turkey and Argentina and elsewhere, unfortunately, it's taken most EM markets down with it, and unfortunately, that means those with current account deficits look particularly vulnerable. Hence, the INR continues to weaken.
There isn't any level at which you may want to come back. You will advise your investors, your customers to buy, for instance, say 73 or 73.5.
Right, it's difficult. I mean, it's almost like catching a falling knife. It's very difficult to say, oh, well, you know, jump in at this level. If you look at the RBI's 36 currency valuation measure and take a long-term deviation, actually the rupee is still not that cheap. So you could argue there's probably even more weakness in the pipeline. So at the moment, it's hard to advise to jump in at 73, 74, just because of the fact that this has become a little bit parabolic in terms of this weakness. That's why you're seeing more concern from the government for the first time in a while. And unfortunately, it doesn't look like it's going to end soon.
Well, let's see if we get any of those measures, as you're mentioning them, in whether it's deposits from the NRI community, whether it's a direct dollar buying window for oil marketing companies, so that demand at least is off the market. Let's see. We're in interesting times.
Those will come. Those will come because now it's getting to be a little treacherous. A final word from you, Irene. Any specific level of the rupee at which you may want to come in and advise buy?
Well, I think, yeah, just now it was mentioned about the valuation,
Yes.
and I think just looking at the chart itself, you know, we estimate that perhaps, you know, a more fair value for the rupee is around 73, that kind of area, you know. So I would say, yeah, we need to reassess the situation if it hits 73, but at the moment we are actually looking at that, you know, as something as a point of reference.